It's tough to talk to an audience who knows everything about what I'm going to say. On the other hand, the mood in the country is so buoyant today that no one minds listening to good news again and again. India decisively voted for change. We are still riding the wave of euphoria, best reflected in the way the stock markets have reacted. After the Sensex crossed 25,000 level, brokerage houses swiftly outdid each other in their forecasts, predicting a quick rise to 28,000, some to 32,000, and some also to 1 lakh by 2020. I have now lost count of these forecasts. But I would not pay much heed to these forecasts. What is important is that there has been a re-rating on India. In the calendar year so far, in the 6.5 odd months, 5.5 odd months, FIIs have invested close to $16 billion in debt and equity. The stock indices have risen 20% this year, making India flavor of the year. The feel-good factor is really high. Many of you may have read a recent research report that said, and I quote, "Besides Rio, India is the only party in town." I want to push this a bit further. Not that I wish to be a party spoiler, but do remember that FIIs are big party hoppers. If they don't like your music, and if they don't like the drink you serve, they will quickly find another party to hop to. We have seen this in the past when India went through turbulent times. So the rally in the markets is largely driven by FIIs. Unfortunately, domestic institutional investors have been far less aggressive, and many domestic institutions have been sellers during this time. Total assets of mutual funds have crossed 10 lakh crores last month, and retail investors are still hesitant. The concern, the worry I have is, unfortunately, the retail investors always get the wrong end of the stick. We find in our mutual fund retail investors coming in now when the market is all-time high. Instead of investing when the market is low, they come when there is a lot of euphoria in the market and the market has already gone up. We have to somehow incentivize retail investors and encourage retail investors to enter our capital market, because the capital market cannot be dominated by foreign institutions. Fortunately, we have growing large number of institutions in India, apart from LIC, which is the main institution. We have 30, 40 life insurance and non-life companies. We have a number of mutual funds with equity schemes. So as we build our equity markets and as we build our institutional market, we need to simultaneously encourage retail investors in the market. The current sentiment, one would expect to see many more IPOs and follow-on offers shortly. Expectations are high. It is now about delivering on these expectations. So before I turn specifically to the financial sector, I'd briefly like to give an overview of the macro situation. I believe India is able to break out of the under 5% GDP growth rate. We cannot afford to grow at such a slow rate that we have done the last 2 years. We need to create sufficient jobs for our younger people. This is not happening, and it has not happened in the last 2-3 years. It is estimated that every 1% increase in GDP growth rate adds to 9 lakh jobs, additional jobs each year. So 1% GDP adds 9 lakh. So when our GDP growth rate came down from 9 to 5%, 3.5 to 4 lakh jobs, 3.5 to 4 million jobs were created less. This we cannot afford. What we need is, the estimates of government is, we need 100 million new jobs in the next 10 years. How are we going to get this unless the economy picks up? How are we going to get jobs for our young people unless manufacturing industry starts kicking in? Next point is agriculture. Agricultural growth is going to be challenging this year, given the predictions that the monsoons will be 7% below normal. A poor monsoon can take out almost 80-90 basis points from the GDP growth rate. But the bigger concern than reduction in GDP is inflation, which is predominantly food inflation. And prices of food grains may go up because of shortages, because of a poor monsoon. So unless there's a willingness to change the supply chain management, food inflation is unlikely to come down. Intermediation costs are the main problem in India. Middlemen, intermediation costs by middlemen are extremely high. According to a World Bank survey, the general thumb rule is a farmer should get 2/3 of the price a consumer pays. In India, the farmer gets 1/3 of the price the consumer pays. So the balance 2/3 are eaten up by intermediaries. This impacts the farmer who gets a lower price, and this increases the cost of a consumer. So we need more private warehousing, we need better supply chain management, we need better cold storage facilities. APMC laws need to be dismantled. The Food Corporation of India needs a complete overhaul. It remains a huge, unwieldy white elephant